the Pew Charitable Trusts to bring this webinar to you. This jointly sponsored webinar will feature a brief presentation on the status of federal tax reform, examples of federal-state tax policy linkages, and use a newly released report from the Pew Charitable Trust on the Mortgage Interest Deduction, the Geographic Distribution of the Mortgage Interest Deduction, to illustrate the varying impacts of federal tax policy and reform on the state. We will have 2 legislator respondents who will discuss how federal tax reform, including but not limited to changes to the mortgage interest deduction, could affect their state. In case you are not familiar with NCSL, we are a bipartisan organization that serves the legislators and staffs of the nation's 50 states, its commonwealths, and territories. NCSL provides research, testimony, and opportunities for policymakers to exchange ideas on the most pressing state issues. NCSL conducts a number of activities related to tax policy. For example, we publish summaries of state legislation, statutes, and other resources, and make the information available through NCSL's website and through testimony to legislative committees. In addition, tax issues are within the jurisdiction of the NCSL Standing Committee on Budgets and Revenue. NCSL Standing Committees allow legislators and legislative staff to exchange state experiences in shaping public policy and managing the legislative institution. The Budgets and Revenue Committee will next meet in person at NCSL's Legislative Summit in Atlanta, Georgia, August 12th through the 15th. For more information on the Legislative Summit or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. We will hear from our 4 distinguished speakers, and then we will open up the discussion to include questions from the audience. After the presentations, the speakers will be able to answer your questions. To ask questions, you can simply type a question in the Q&A box in the right-hand corner of your screen. We will take as many questions as possible within the time we have available. Our first speaker, Michael Ettlinger, is a Senior Director of Pew's Fiscal and Economic Policy Portfolio, a multifaceted set of projects and initiatives that research fiscal and economic issues and promote evidence-based policies and practices at all levels of government. As the head of this portfolio, Mr. Ettlinger leads a staff of experts that includes researchers, project analysts, journalists, and consultants, and guides the direction of Pew's work to provide critical data and analyses that strengthen fiscal and economic policy across federal, state, and local levels. Welcome, Mr. Ettlinger.
Thank you, Heather. So tax reform is definitely in the wind here in D.C. But of course, lots of things get into the wind in D.C. and don't necessarily happen. So I think, the first question is, what are the odds of this actually happening? And I think the first thing that we kind of all know is that tax reform is really tough. It's a hard thing to make happen. I think any of you who've had that experience of trying to push through tax reform at any level of government know that. And the fundamental challenge is that any practical reform that's anywhere near revenue neutral is going to involve cutting taxes for some taxpayers and raising them for others. And it's almost a universal rule that those whose taxes go up in a reform are a lot more upset than those whose taxes go down, and that creates a very difficult political dynamic. And I think what you tend to need to have tax reform to go forward is a level of trust among the participants that when it's all over, it's not going to descend into a whole lot of finger pointing and people saying about their other participants that they're responsible for people's taxes going up. And I think that's what we saw in 1986 when the last major federal tax reform happened, when you had President Reagan and congressional Republicans and Democrats were able to develop that level of trust. And so I think one critical question is whether the current players can develop that kind of trust and move ahead, because it's hard to see the parties taking the political risks involved in pursuing tax reform if that kind of trust doesn't develop. And that's not even to mention the policy differences, which there obviously are some. So that said, it is tough. It is a challenge. There are also signs that, in fact, this is the time where we might actually see reform. One sign is simply that everyone agrees it's needed, and although there are differences among the parties about what exactly reform should look like, there is actually a lot of overlap across ideology, political party, and interest groups on some areas where you know there's overlap, that there are certain problems that they all share a belief need to be addressed. There are areas outside of that overlap, but there is a lot of overlap as well. The second thing is that the Republican chairman of the House Ways and Means Committee, Dave Camp of Michigan, is term limited in his committee chairmanship and is you know very committed to wanting to get this done before he leaves that position. And I think a good sign of this was when he came out with his corporate tax reform proposal, you know, which definitely reflected where he's coming from. But it also was seen by Democrats as very much a legitimate opening offer to them. It wasn't seen as just taking a you know, a one-sided position. The third thing is that on the Democratic and Senate side, the chairman of the Senate Finance Committee, Max Baucus of Montana, isn't running. He's going to be retiring. He's not going to be running for re-election, which makes him less risk-averse. You know, I think it makes it much easier for him to participate prominently, as he'd have to in any reform, and deal with the various wings of his own party and the Republicans, and move ahead without, you know, having to be overly concerned with how it plays back home in Montana. So I think, you know, he has a lot more freedom of motion in this. And the president has wanted to do this for some time and has said so. So when you take all of those things together, there is a sign that you know, this might be the time when there could be a breakthrough on this. And you know, one additional sign of this is the fact that Senator Baucus and Representative Camp have actually joined together to launch taxreform.gov, or tweeting under Max and Dave under the handle Simpler Taxes. So, you know, to the extent that means something, it's a good sign for reform moving ahead. You know, and there actually are some fairly concrete steps that are being taken right now. You know, the administration has at various times put out pieces that could be part of a broader reform on the table, and both Ways and Means and Senate Finance are right now engaging in bipartisan processes, both to educate themselves about, you know, the various aspects of reform and exploring the options. So things are moving kind of on the back burner in that way. I would say, looking ahead, and if you're looking for signs of whether reform is going to happen, one big place to look is what happens when we get into the debt limit increase issue, probably this fall. That's likely a vehicle where there'll be at least an attempt to attach instructions to the tax writing committees for parameters for tax reform. And if there's an agreement on such instructions, that would be a big sign that they're very serious about trying to move ahead. It wouldn't be a done deal that it would happen, but that means they're really going to take it on seriously, and that there's a broad feeling in Congress that to try to do that. I would say even if it doesn't actually make it into legislation, which they might not for reasons unrelated to tax reform, if the discussion around that, which there's almost certain to be, is reasonably civil and constructive, again, I think that's a sign that reform at least isn't dead. On the other hand, if you see people really, you know, getting their backs up and acrimony, finger pointing, getting into hardened positions around that time, around tax reform, then it's probably you're not going to see it happen at least through 2014. So, I mean, that's basically the lay of the land in terms of federal tax reform in D.C., but of course this isn't just a federal issue. As you all know, and probably why you're on the call, is that states are very linked to federal tax code in a variety of ways. And policymakers really need good data not only on the national implications of federal tax reform, but also on how these policy changes are likely to impact state revenues and state economies. And that's why Kasia is here. So I'm going to turn it over to Kasia, who will elaborate on some of the different ways that states could be affected by federal level tax reform. Kasia?
Thank you, Mr. Ettlinger. Our second speaker, Kasia O'Neill Murray, is a project manager for the Fiscal Federalism Initiative, which examines the fiscal and policy relationships between federal and state governments. As a manager of the project research portfolio, Ms. Murray oversees a robust analytical agenda exploring the impact of federal deficit reduction on the state. Welcome, Ms. Murray.
Thanks, Heather. Although tax reform is clearly being talked about in a variety of contexts, one aspect is getting very little attention, and that is how changes to the federal tax system would affect the states with regard to both their revenues and their economies. What we're finding is that these federal-state connections aren't always clearly understood. So to start filling that information gap, Pew started to take a deeper look at the linkages between federal and state tax codes. Last November, we released a report on the impact of the fiscal cliff on the states, which was a 50-state look at how both the tax and the spending sides of the fiscal cliff could affect the state. On the spending side, it's fairly intuitive that if you cut federal grants to states, state budgets would be affected. However, the direct tax connections were just not part of the conversation. So our report highlighted several statutory linkages between the state and federal tax codes, whereby a change at the federal level would automatically affect state revenues. Understanding these connections forms the basis for analyzing some of the state impacts of proposed federal reforms. We found that because state tax codes piggyback on the federal code in a variety of different ways, policy changes on the federal side can automatically result in revenue increases or decreases at the state level. So for example, we found 6 states allow their taxpayers to deduct federal income taxes from their state taxes, and so any changes to federal income tax liability would change the state deduction amounts, and that would automatically raise or lower state revenues without states taking any action at all. At least 25 states in D.C. link to personal deductions like the one for interest on student loans. If any of these deductions were reduced or eliminated at the federal level, the same thing would happen at the state level. So that means the states that link to the federal deduction would automatically see higher revenues. Some states also link to various itemized deductions like the one for mortgage interest, and for these states, federal changes to this group of tax expenditures, such as a cap on their value, could automatically change state revenues. We also took a look at a couple of tax credits. At least 30 states and D.C. link to the earned income tax credit, for example. If it's reduced or eliminated, these states would see higher revenues. And then finally, on the business side, we found nearly half of the states linked to the federal bonus depreciation and enhanced expensing provisions. When such federal deductions are expanded, these states see lower revenues. Of course, we know state policymakers have the option and the flexibility to choose whether and how they want their state's tax code to link to the federal code. They can decide to maintain whatever conformity is already in place and accept the increases or decreases in revenues as a result of a change in federal policy, or they can decide to respond to the federal changes by amending their tax codes in a way that reduces or eliminates the effect of the federal change on their state revenues. The point here is that each state links in different ways to the federal code, and that's why federal policymakers really need data across every one of the 50 states to understand how federal tax policy changes could affect the states. Now, beyond the direct state revenue impacts that we're talking about, federal tax changes can, of course, have economic impacts as well. So even if a state doesn't directly link to the federal tax code, if federal tax changes reduce or increase the amount of federal taxes paid by entities within a state, that translates into more or less disposable income, which can in turn affect spending and economic conditions and then indirectly affect state revenues. With comprehensive tax reform on the table, changes to tax expenditures are part of the discussion, and we've begun looking at what changes to them might mean for the states. Last month, we released an initial report on one of the biggest and most familiar tax expenditures, the mortgage interest deduction. We mapped out the geographic distribution of this deduction, looking at the claim rates and the average deduction amounts across every state. What mapping the mortgage interest deduction showed is that it's actually spread unevenly across the state. So that means not all states or even areas within the same state benefit in the same way from this popular itemized deduction. Furthermore, any changes to the deduction would likely result in a different distribution and have different impacts across and within the state. Now, before showing you what we found, I want to just briefly explain why we looked at the mortgage interest deduction. First, it's consistently the second or third largest single tax expenditure. In 2011, Americans deducted about $360 billion in mortgage interest, and that resulted in about $72 billion in foregone federal tax revenue. There also seems to be emerging consensus that federal tax expenditures could be changed as part of tax reform or deficit reduction. Altogether, tax expenditures total around $1.1 trillion every year, which rivals the total amount of federal discretionary spending. And then despite its popularity, and even though the mortgage interest deduction is closely associated with the American dream of home ownership, nationally only around half of all homeowners and about a quarter of all tax filers actually claim it. So given the different proposals to reform tax expenditures generally, such as capping all itemized deductions, or specific changes to the mortgage interest deduction itself, our aim was to provide some baseline data that could help policymakers as they try to figure out which states and which areas within each state could be most affected by any change. So I'm going to show you some of the maps we used to tell the story. This first map shows claim rates across the states, and the claim rate is the percentage of all tax filers who claim the deduction. You can see in the map that the highest rates are concentrated in states along the East Coast, in parts of the West, and then up in the Great Lakes region. These findings are fairly intuitive in that many of these states have relatively high incomes and property values, but some of the findings might challenge conventional assumptions. You see, for example, you have Minnesota and Utah with the 5th and the 6th highest claim rates, while New York State ranks 35th. Another really interesting finding was the scale of the differences. For example, 37% of tax filers in Maryland claim the deduction compared with 15% of filers in West Virginia and North Dakota. This next map we think is really cool because it's the first ever look at the mortgage interest deduction all the way down to the zip code level. We used IRS's one and only release of detailed zip code data to create a series of these maps. And in this specific map here, showing the claim rates, you can see that there are concentrations in and around some of the larger metro areas throughout the country. There's a notable concentration along the Boston-Washington corridor and in and around metro areas in Colorado and California. And you can also see from the pockets of the lighter shades in the map that generally less populated areas of the country tended to have lower claim rates. However, that's not always the case. Some major metro areas like New York City had claim rates well below the national average, while some smaller areas like Raleigh, North Carolina, had claim rates well above the national average. As with the state data, what was particularly striking here was the range of the values, ranging from 40% in the suburban DC area to less than 10% in a place like Odessa, Texas. The detailed zip code data allowed us to take an in-depth look at what's going on within individual states, so we could compare the claim rates and the average deductions across the metro areas within a state. I'll show you briefly what we found for Pennsylvania. As in a lot of states, in Pennsylvania, the claim rates and average deductions ranged pretty widely across the metro areas. What we found interesting about this state is that the distribution really didn't line up according to the population size of each metro area. So you can see in this map, the state's second most populous area, Pittsburgh, had a relatively low claim rate of around 21%, and that compares to the York-Hanover area, a relatively smaller area that had a claim rate of 31%. So we have a really fun interactive that where you can zoom down from the state level all the way down to the zip code level. You can enter in your own zip code and play around with it to see what's going on in each area across the country. So the key takeaway from this report is that when analyzing the impact of changes to federal tax policy, national averages and even the state averages don't tell the whole story. Changes are likely to have really different impacts across the states and within the states, meaning tax filers in certain areas could see an increase in taxes while filers in other areas could see a decrease. We've just started to scratch the surface of all the connections between federal and state taxes, and we're currently developing a 50-state tax model to estimate the state revenue impacts of various federal changes. We're also taking a deeper 50-state look into other tax expenditures. For example, we know states are particularly focused on the deduction for state and local taxes and the exclusion of interest in state and local bonds. Information about the state impacts is largely missing from the current federal debate, so our goal is really to provide some of the missing data so that policymakers can make decisions knowing their full impacts. We're really looking forward to hearing more now about these and other tax issues that are of most concern to the states, and I'm happy to take any questions you have later during our general Q&A. Thanks.
Thank you, Ms. Murray. Our third speaker, Delores Kelley, was elected to the Maryland House of Delegates in 1990 and has been the senator for Maryland's 10th legislative district since January 1995. In the Maryland legislature, Senator Kelley is chair of the Executive Nominations Committee and Senate Vice Chair of the Joint Committee on Health Care Delivery and Financing. She is also a member of the Senate Finance Committee and the Joint Committee on Unemployment Insurance Oversight. Senator Kelley is also a member of the Maryland Foreclosure Task Force and is a past chair of NCSL's Communications, Financial Services, and Interstate Commerce Committee. Welcome, Senator Kelley.
Thank you. Well, let me start by saying that we've got some changes now from Washington, but they are unthoughtful changes, a lot of cutting of expenditures across the board. And the current sequestration is really having a significant impact on Maryland's economy. Because of our geographic proximity to the district, a relatively high percentage of Maryland residents are federal employees and are now experiencing indefinite furloughs and therefore are less able in many cases to even make their regular mortgage payments without any consideration of the loss of the exclusion for mortgage interest. At this point in time, were the Congress to cap or to eliminate the mortgage interest deduction, additional Marylanders employed by defense contractors and who have declining federal contracts and revenues would likewise experience a double whammy. Now, it is true that Maryland is a relatively high-income state, with one of the highest percentages of filers claiming the mortgage interest deduction, a tax expenditure applying more often in high-income counties within Maryland and among higher-income filers. However, Maryland partially offsets such skewed application of this tax benefit by providing to lower income filers who itemize either a renter's credit or a larger property tax deduction. Now, last year in 2012, we raised the tax rate on higher income filers, so we made the code more progressive, and again, that's a way of impacting or deleveraging some of the skewing that the mortgage interest deduction has for higher income filers. Other so-called federal tax reforms that would be harmful to Maryland and to every state would be the elimination of the federal exclusion of interest earned by tax filers for municipal bonds and other tax-exempt bonds. Within the past few months, we became nervous in Maryland to hear President Obama and Speaker Boehner indicate their willingness to cap all federal deductions. Also, when we look at the 2010 Simpson-Bowles Commission report, they included in it an illustrative proposal, that's what they called it, that would end the exclusion of municipal and other tax-exempt bonds from the income of federal tax filers. All states secure public funding for capital projects this way more often than in any other way, and they do it in the public interest. So if we lost that expenditure, there would be problems with construction of schools, hospitals, bridges, public utilities. The states would no longer be able to sell these bonds at below market rate and attract investors at all if the interest earned on these bonds were no longer tax exempt. I would just say that federal tax reform must respect state sovereignty. It must avoid the preemption of states' rights. And we really need the National Governors Association and NCSL at the table, given some kind of input on a constant basis if they really are going to do serious tax reform at the federal level. Maybe the Pew Charitable Trusts ought to be there with the new outcomes they're going to have given their enlarged research emphasis, so that someone who understands the impact on the states, and these impacts will vary from state to state, given the different ways in which most of us are linked to the federal income tax code and a few not being such linked. So that's my take on it at this point in time. And I would say to everybody, remind our folks in Washington that the taxpayers they are serving are the same ones that we have to serve, and at a more basic level.
Thank you, Senator Kelley. Our final speaker, Dan Flynn, is in his 6th term representing House District 2 in the Texas House of Representatives. During the 83rd session of the Texas Legislature, Representative Flynn serves as co-chairman of the House Select Committee on Transparency and State Agency Operations. He also serves as vice chair of the House Committee on Investments and Financial Services and as a member of the House Committee on Homeland Security and Public Safety. Representative Flynn serves as a co-chair of the NTSL Military and Veterans Affairs Task Force and is a former chair of the NTSL's Budgets and Revenue Committee. Welcome, Representative Flynn.
Just listening to Senator Kelley, and I think she and I must have gone to that same school on the 10th Amendment states' rights there, because I agree with her. As we're looking at the issues that we're discussing here, you know, in Texas, real estate is certainly the backbone of growth, and with real estate just beginning to start its comeback, it would have a very adverse effect on sales and home ownership if that mortgage interest deduction was changed. I think that would absolutely translate into less jobs growth, loss of jobs, and new construction would be diminished. And of course, we've been very fortunate here. We've had low unemployment, and we've been very fortunate in how our economy has stayed somewhat stable, even though we've had a setback just like so many of the other states. In tracking regarding the impact of that federal tax reform, we're all tracking the cost of small business and overall impact of the healthcare reform on small businesses that they're taxed on that program. This is one that's very concerning to the folks that I deal with and talk to, because there are a lot of taxes that have come out of that were not necessarily anticipated. And of course, we're tracking the deep concerns on taxing small businesses by adding taxes to these owners of these small businesses that report their income through personal income tax forms And the impact of this process would also have a diminishing or even a halting job growth, because small business, I think just about any survey or that we discuss or look at shows that small business is really the lifeblood of economic growth and gain in so many of our states. As far as impacts on state revenues that are of greater concern, I just believe that the unchecked growth of entitlement spending, combined with a future that looks like federal funds to support state efforts across the board, will have to be decreased in order to pay for these entitlements. It means that education and transportation and other potential decreases in the federal funding will have to be made up by the states. And you know, in our state, we do not have a state income tax, so that would require us to either cut back on those areas that the state is involved with, or increase taxes. And right now, that's not a very pleasant word, whether it be on the state or the federal level. As far as some of the economic impacts that are our great concerns, I think the lack of just an efficient federal tax system for individuals is something that is most concerning. It seems like when you make calls in, you're just not always getting the same answer if you talk to 2 different people or 3 different people, and I think that there's just a real lack of an efficient federal tax system for the individuals. And of course, without being political, just the current environment that we're having, that questions regarding the tax collecting systems is a great concern to everyone. And I think that lack of an efficient federal system for business creates that uncertainty. And when small businesses are uncertain, even large businesses, when they don't know exactly what to expect from a tax system, it tends to restrain growth, and it causes them not to want to go into new programs or even new projects that would be good. An increase in current regulation across all the agencies of federal government has created this added expense to businesses that could have been used for hiring. And you don't have to look very far back to just see the incredible regulations that have been increased on recent. We've discussed, just for an example, the Dodd-Frank. Here's a piece of legislation that, for the banking industry, is over 750 new banking regulations, and they're only halfway through that program that's 3 years old. And so those are the things that are really concerning. I think as far as tax policy and changes that should be considered at our level, the state level, we have worked, we're just coming out of our regular session, and we were charged by our governor to eliminate about $1.8 billion in our tax, giving that kind of breaks to our citizens. We got pretty close to it. We got, I think it's about $1.3 billion is what we're currently on, but I strongly suspicion with a line item veto that we have in Texas for our governor that we'll see him find some more relief. So I think eliminating of the franchise tax that we have is something that we're going to be looking at, because that's been something that's been very unpopular among our small businesses. Ending of diversions by making more revenue part of the general revenue versus having dedicated funds. I think that's something we'll be looking at. And then, of course, the elimination and replacement of property tax system with some type of an alternative system. Now, what that system is, I guess it's kind of that normal government program. We're going to be studying it. But I think that that's certainly something that we're going to look at, because property taxes in our state are much higher than the public wants them to be, and we're going to have to find a way to be able to provide those needed services without overtaxation. And we'll be looking to NCSL to help us find those opportunities.
Thank you, Representative Flynn. Now that we've heard from the distinguished speakers, we are happy to take questions. Again, as I said before, to ask a question, please type your question into the question box or Q&A box that's in the right-hand corner of your screen. As we are waiting for your questions, I want to let you know that this webinar is being recorded and will be archived on the NCSL website. Okay, to start off, we do have a question for either Michael or Kasia. Doesn't the geographic distribution of the mortgage interest deduction simply reflect the places where income and home values or home prices are highest?
Oh, thanks, Heather. This is Kasia. Some of the findings are fairly intuitive, but the point here really is that policymakers, in order to make decisions, really need some of this information quantified and mapped out to really see what's going on, instead of relying on assumptions about where the distribution might be. There are other factors that influence the distribution beyond housing values and incomes. For example, housing turnover rates and the proportion of renters to homeowners, and even the structure of the mortgage interest deduction itself, like it being available for second homes or for mortgage debt up to $1 million and only available to tax filers who itemize deductions. These are all other factors that come into play.
Okay, thank you. Senator Kelley, this is the question. Next question is for you.
Okay.
With Maryland's economy so closely tied with Washington, D.C.'s, along with its relatively high claim rate for the mortgage interest deduction, what steps has Maryland taken in preparing for any potential impacts of federal tax reform?
Well, as I said earlier, Maryland is involved in making more progressive the personal income tax code, and we do offer renters credits and also property tax credits to low-income filers that we're worried about. If you think about it, the very people that the new FCPB under Dodd-Frank is trying to help by forcing the banks and other financial institutions to engage in very, very different mortgage servicing criteria, those same low-income home buyers are going to be as hit and maybe worse hit by the loss of the mortgage interest deduction. In fact, many fewer people will be able to afford a home in America at all if the mortgage interest deduction in Maryland were lost. So I know that my fellow legislators are very concerned that with one hand we give and we ask the banks to do more to protect a category of home buyers who such a federal reform, if you call it a reform, would in fact harm.
Thank you, Senator. The next question is for either Michael or for Kasia. Do you think that proposed changes to federal tax policies could lead to states decoupling their tax policies from the federal policies?
Thanks, Heather. This is Kasia again. You know, states couple to the federal tax code for lots of reasons, including ease of compliance for their tax filers, administrative simplicity, enforcement issues, and then sometimes because they share similar policy goals. But of course, there are some challenges associated with coupling, and those mostly involve timing issues. For example, if federal tax changes are made at the last minute, that leaves states facing administrative challenges and challenges associated with revenue forecasting. So we certainly don't know what states would choose to do. We do know states do weigh the pros and cons of coupling, and you know they have made decisions in the past with federal tax reform. For example, in the 80s, some states decoupled from some of the business provisions. So states are constantly looking at this. I think I would love to hear from our other panelists what their views on this issue are.
Well, in fact, in Maryland, we also did decouple to some degree where business items in the tax code were concerned. But really for tax simplicity and to make it not so hard for people to comply and not to have to go out and all hire high-priced CPAs in order to help them with their tax filing, it makes sense to couple or to link to the tax code where applicable, and that works for us.
I would sure agree with that, because businesses got to have a understanding and a confidence that there's going to be a stable environment so that they can make their long-range forecast and know what to expect. And having a simpler tax code would, I think, would be a benefit to not only business but to individuals.
Yeah, this is Michael. I just chime in and say that, I think what this would do, if there was a broad tax reform, it would definitely shake things up. And I think that, you might see both more and less coupling, right? Because just there would be things that would be different in the federal tax system, some of which states would find appealing to attach themselves to, and some that they would find less appealing. Just to add one thing related to the last comment, I think one virtue of reform, almost any reform, is that there would be a sense that the system had stabilized for a while after it, and so I think that that's one thing that could be a benefit of reform just nationally, economically, is the sense that the system isn't going to be changing a lot in a while because they just went through the big effort of getting it to where there was kind of some form of consensus.
Actually, one thing that the feds could do that would help almost all of the states, because most of us do have sales taxes, and while they are figuring out what to do for their own reform, is to give us the Marketplace Fairness Act, so that taxes that are already owed, sales taxes to the states, could be collected by remote vendors. It's unfair to our brick and mortar vendors to do all of the collecting, to become just showrooms for people who are shopping, and then to have them go on the internet to buy because they can avoid paying us the state taxes that we are due. I think if they would just do that, and since this version has already passed the Senate and it only needs to pass one more House, if they were to do that while they're figuring out what else, all of us with sales taxes would get billions of dollars and we would do more for ourselves.
I think anytime, this is Dan Flynn, anytime we could have a simpler tax code and one that everyone can understand and have a fair evaluation, that's what I think the citizens are looking for.
All right, thank you. Our next question is that I'm just going to read it as if I'm the actual person asking it. So I'm hearing that the citizen idea of reform is to make it simpler. Has InfuSil surveyed the states to determine whether there is a consensus idea among the states as to what sort of reform is desirous from their fiscal perspective? Before we try to answer that, would Kasia or Michael, would you like to talk about that?
Well, there's a sort of an old saying in tax policy that any provision that raises simplification is in the eyes of the beholder, and any provision that raises my taxes doesn't make them simpler, and any provision that does lower my taxes makes it simpler. So I think just with regard to simplification, I think there is real tension between, if you simplify, again referring to what I talked about in what I said at the beginning, was, simplifying just by definition it almost involves raising some people's taxes and lowering other people's taxes. So while everyone's for simplification, actually doing it is quite challenging.
Okay. And
Liberty,
go
can
ahead.
I just throw something in there?
Yes,
this
please.
is Dan Flynn. It just seems to me like that the thousands of pages of the federal tax code, you know, we would do well to just maybe start over and make a code that would be something that, as Senator Kelley was saying, where you don't have to go get a high-priced accountant to be able to file your income tax. And I think that's what the public is crying for, is they want to be able to understand it and be able to file their tax return.
This is Delores Kelley, and I would just add that the work that the Pew Charitable Trust has done to really categorize how these states are doing tax expenditures that most of our filers aren't even aware of when you look at it in the aggregate, is something that maybe we ought to all take more, pay more attention to. I'd like to see the Pew Charitable Trust also list broad categories of federal tax expenditures. In other words, when we give deductions, exemptions, and especially the credits, we give so many credits, and I'm now counting hundreds of them that we do in Maryland, and that is giving away the funds that otherwise you would collect. And in order to do that, you've got to raise everybody's tax rates in order to do all of these credits. Why not have fewer credits? Why not reduce the overall tax rates and make things simpler that way?
All right, thank you. And looking at our document, NCSL does have a policy position that advances and defends a balanced and dynamic partnership among the local, state, and federal governments on fundamental tax reform. But at this point, we have not done a survey on this issue, and we do appreciate the suggestion. Okay, so shifting gears a little to another question, Representative Flynn, this question is for you. What is the biggest federal tax issue you are following in Texas that you think would have a significant impact on your state?
I think it's really, when you say what is the issue is the uncertainty of it. It seems like that every time I have an opportunity to talk with any of my constituents or even my colleagues, that's the concern that we all have is the uncertainty of the direction it might be going. The mortgage interest is no question a big interest that everyone feels we need to maintain that, because as we discussed, that's the lifeblood of the backbone of growth of the real estate industry, which you know, those rooftops are what build communities and create jobs. So I think that's probably the other thing. Of course, in a state like Texas, we have an awful lot of rural area. And in that rural area, a lot of our land is ag exempt. Those are things that people talk about a lot. Of course, usually that's the people in the cities talking about the ag exemption, and people in the ag that want to maintain it. So there's a happy medium that we have to work with there. And you know, the federal government has from time to time mentioned those issues. But I think that the state would like to be able to control their tax growth, their burdens, as much as they could, and to maintain as much of their funds without interference from federal government.
Thank you, Representative Flynn. We do have another question, and this one is directed to both Senator Kelley and Representative Flynn. And the question is isn't the problem with tax expenditures is that every deduction in the tax code is essentially someone's sacred cow, and that they will fight to keep it?
No question. Every time we've looked at doing tax reform in our state, you know, it's always very key to all of us that every one of those exemptions has a very large contingency, has a very large group of people that are wanting to protect their area. And you know what? That's I guess it's kind of a cliche, but that's kind of what you get elected for, is you have to make some of those hard, tough decisions. And I know during my tenure we've had to make some decisions that everybody's not going to be happy, but what you want to try to do is make as fair evaluation as you possibly can to where you can be able to meet the needs and not necessarily all the wants of the public.
Yes, these are people's sacred cows, but I think if they were all put on the auction block together with the view of reducing everybody's tax rates in the long run. For an example, if we could reduce certain business tax rates right now, funds that are being held by American companies overseas would be brought back and we would create some jobs. But they aren't going to bring those funds back to the U.S. With the rates that we have right now, which are necessary for us to give out all of these credits. We don't know altogether how the credits work, and they probably are causing us to keep the rates higher than need be and jobs offshore that could come home.
I sure agree with that.
All right, thank you so much. Our last question, and this one's maybe slightly a little off topic, but it's intriguing, is in the meantime, while these tax changes are being discussed and hashed out at the congressional level, should states be making any effort through programs or anything or education that would then encourage more homeowners to claim their mortgage interest tax deduction?
That certainly would make a lot of sense, especially with Dodd-Frank trying to encourage home growth through all of these new mortgage servicing requirements and upfront considerations of whether people can afford to even have a mortgage. Obviously, they can afford it more easily if they keep that particular tax deduction. But we really do need to look at all of that. I would just say also that here in Maryland, based on my thinking at this point, I think we ought to all put our list of tax exemptions, our tax expenditures together and online for all to see. I think if everybody were more aware of what all of the list of expenditures are, we could more intelligently decide what makes sense at the current time and what is obsolete. Some of this stuff is obsolete.
Yeah, I think it goes back to everything we've been talking about today, and that is you've got to have a simpler tax effort here where people can understand it. As far as the lenders are concerned, lenders are going to continue to hold on to their money until they can have a simpler program of what kind of rules and regulations are going to be out there, and they're going to back away from even being involved in the mortgage lending business. And until we free that up, we're going to have continued slow marketplace, and with that slow market, that means that less jobs and builders are not going to be building homes if they can't sell them. So I think those are all the issues that have to be considered, and a simple tax code and less regulation on small business and the individual.
I would agree.
Kasia or Michael, did you want to respond to that question?
I think they covered it.
All right. Well, thank you very much. And this brings us to the conclusion of this webinar. If you have any questions following this event, please feel free to contact NTSL Erica Michael, and her contact information is listed on the screen. Yeah, there it is. And as a reminder, the full text of the report highlighted today, along with additional resources, is available through the NTSL website. I would like to thank all of the panelists for taking the time for their busy schedules today to participate, and thank you all for participating and listening in on the webinar today.
And thank NTSL for their willingness to allow this participation to be available.
Thanks a lot.